Thank you everyone for joining us. Today we have three very senior fund management professionals joining us today from SeaTown. And this is a very interesting topic because I don't think that private credit is a very well-known product or asset class, but it is certainly growing in the last few years for a variety of reasons. And here we have today three gentlemen from SeaTown to talk to us about what they're doing in the private credit space and certainly what they're seeing in terms of trends going forward. Just to let everybody know, this is obviously not an offer or an invitation to invest in anything. This is a non-deal webinar. So let's get to it. Our first guest this evening is Eddie Ong. Eddie is the Deputy CIO and Head of Private Investments at SeaTown. He's responsible for both private credit and private equity investments. So if anybody wants to ask a question around what is the difference and what are the trends he's seeing, that would be fantastic. Before joining SeaTown, Eddie was SVP at Wahin and also previously a director at DKR Oasis, a multi-strategy hedge fund. Before joining DKR Oasis, Eddie was at Temasek Holdings Direct Investment Division. And before the buy side, Eddie actually spent many years as a corporate banker with DBS Bank. Our next speaker is Chan Wei Xian. Wei Xian is an MD of private investments at SeaTown, and he's responsible for investing in the private credit space. Before joining SeaTown, Wei Xian spent 6 years at UBS and Merrill Lynch investing in public equities. And prior to that, he was a private equity investor at IFC, Morgan Stanley, and Henderson Global Investors. Our third speaker is Wee Yap. Wee Yap is also Managing Director, Private Investments of SeaTown, and also responsible for investing in private credit. Before joining the firm, Wee Yap was CEO of Fullerton Investment Management, which is a wholly owned subsidiary of Fullerton Financial Holdings. And before that, the head of mezzanine capital at UOB Bank, focusing on Asia Pacific private debt opportunities, as well as the chairman of the investment committee there. Prior to that, Wee Yap was at JP Morgan covering pre-IPO financing and other forms of private financing. And before that, with DBS Private Equity covering Greater China and Southeast Asia. And it seems that he has years of experience in the lending space. I won't go too much into myself. I think a lot of you have heard me speak many times. I'm the Chief Commercial Officer of ADDX, and I'm very happy here to be hosting the SeaTown team. Next slide, please. Just a reminder for everyone, there is a Q&A button right at the bottom of the bar for the Zoom webinar. So please ask many questions. This is a very interesting topic, and I think everyone will have lots of questions here. But please click on the Q&A and we can try and handle most of your questions at the end of the session. We will run this a little bit fireside chat style because there's so much to cover. I think let's focus on the topical ones. But maybe I'll start off with the first question here for Eddie to introduce SeaTown. I think everyone sort of heard what SeaTown is, but it'd be great to get a better introduction into SeaTown, what you guys have been doing since inception.
Hey, Oi, thanks for that. And good evening, everyone. Thanks for taking the time with us. I think before we actually talk a little bit more about private credit, I think it's good to have some background on the genesis of SeaTown. SeaTown is really a asset manager in the alternative space that was set up back in 2009. We are fully funded by Temasek Holdings then. And we invest in a variety of strategies, both in the private and the public space, equities and credit, and even some macro strategies. So in those years, since 2009 to 2019, one of the asset classes that was particularly interesting for us was pretty much the private credit space. Now, the private credit space is something that it's still quite in the nascent stage, right? When it started off back in 2012 with us. And it has grown, right, over time from strength to strength, given that it's a very sort of a, early part of its life cycle compared to what we are seeing in the other developed markets, right? So since 2012 to to 2019, we have done north of $2 billion worth of private credit transactions and invested in over 48 transactions across 14 countries and 10 sectors. So that's kind of like where we are really today. While SeaTown has other strategies in its portfolio as well, it is today a $6 billion company in terms of asset under management. We continue to run these various strategies as a dedicated fund and with dedicated teams. So I'll just stop right there, to see if there are any questions.
Well, let's move on to the next question, which I think was a great lead-in. SeaTown's obviously covered both the listed equity and as you mentioned, private credit. And I know your experience, at least have cut across private credit and other types, but our investors will probably be less familiar with private credit as an asset class. Can you briefly describe what it is and how it actually differs from more traditional credit strategies like investment grade or high yield bonds, that investors are a bit more familiar with?
Sure. So before getting too technical about it, I think the way to think about private credit is in a very simplistic terms, right? I think most people are quite familiar with public credits. In other words, you do invest in publicly listed bonds. Well, these bonds can be in the investment grade space, or they can be in a high yield space, right? Those that are below investment grade, right? And then most of these public listed bonds are traded daily on whatever listed exchange, and then there's liquidity. You could trade this product. You could get out or get invested into this product on a daily basis. Now, private credit, on the other hand, are similar in nature, except that the instrument is similar, except that it doesn't have a daily liquidity. I mean, a lot of these credits are actually structured privately with the borrower, right? It often comes with it quite a customized set of credit covenants that could include collateral in the process. It could include certain cash flow sweep mechanism, for example, or it could be secured by some other collateral that is outside of that bond or that loan, and even include certain equity kicker. So when you talk about private credit, while the nature of the instrument is essentially credit, pretty much like a public listed bond, it is in effect an instrument where, quite apart from the lack of liquidity that allows you to trade in and out on a daily basis, the other benefit is that it's got a lot of scope for customization of the credit structure to either improve your credit downside protection, or to have additional upside kicker. And oftentimes it can come with also both features. So that's pretty much when one should think about when they think about private credit.
But who are some of these typical borrowers of private credit? And I know you showed some broad return ranges. Investors like yourself in this private credit, how do you think about returns?
Okay, so if you look at very simply the various private credit strategy, I think it runs on a continuum from the less risky to the more risky spectrum. And then in the less risky spectrum, we are pretty much looking at similar to investment grade public listed credit. These are kind of like senior private credit, right? You are probably in the senior part of the capital structure, right? And it gets and you rank ahead, right, of the other junior debt that sits below you. And oftentimes they are instruments that you lend to can be private companies or there can be listed companies. At the end of the day, the private credit investment managers like us, we look at pretty much the credit metrics, the fundamentals of the credit that underlies these private credits as well. Not too different from a public credit analysis, right? But ourselves, we have a lot more covenants in there that tend to preserve capital, maximize returns in a way that I think would deviate from more of the standardized form of public listed credit that you see. So yes, so in that sense, I would say it can be the same sort of borrower as what you see on the public listed credit space.
Thank you for that. I think the next question we have here, private credit is quite a broad umbrella though. And within that, there's still quite a lot of subsets. Are there different strategies within this broad coverage of private credit?
There are. If you look at it in general, the more, I would say, lower return and therefore safer and lower volatility kind of a private credit space, you'll be looking at more senior type of lending, direct lending. You only participate in the sort of the senior performing credit space. Now, and then there are also the equivalent of a high yield in a private credit, whereby you actually participate more in the sliver that sits below the senior credit. It could be in a mezzanine form, or it could be kind of like a second lien that is privately structured. And these are definitely higher yielding than the senior credit. And then you can go to the other end of the extreme where the credit return is more equity-like. So you'll be looking at more of the special situations sort of strategies and / distress kind of cases where you could easily shoot for, say, mid to high teens sort of returns. I think that's pretty much the spectrum of, in general, what we see here in Asia, private credit. And from time to time, there can also be very specialized sort of financing strategies when you talk about aviation finance, when you start talking about healthcare, royalties kind of financing, that we tend to see more of these in the developed market world. So these are called some of the a bit more specialized and generally higher risk kind of private credit space.
I think the next question is for Wei Xian. Can you tell our viewers actually how big the private credit market is globally? And who are the usual investors in this private credit market? And actually, what is making this asset class attractive to these investors?
Thanks for the question. Yes, this is a great question. Global private credit AUM has been growing rapidly and has reached 951 billion as of June of last year. And there's a very broad range of investors. They include, anywhere from sovereign funds, pension funds, endowments, insurance companies, corporates, family offices too. And why are they all interested in private credit? Well, the main attraction of this asset class is you get stable contractual returns that are superior to those that are available in the public credit markets. I mean, such as IG or high yield bonds, and I guess even more start with the bank deposits, which are barely paying anything these days. Thanks.
Great. Next question, I think still with you, Wei Xian. Shall we maybe zoom in a little bit on the private credit market in Asia? I mean, as we discussed, it's not actually such a well-known asset class, probably for a number of our participants today. How does the market in Asia compare to the private credit markets in other regions like Europe and US? And how have you all seen the shifts in the trends? Obviously, you've been looking at this, or SeaTown has been looking at this for a long time. How have the trends been shifting?
Yes, thanks. Yeah, so private credit in Asia is a really exciting opportunity. It is growing much faster than in Europe and the US from a much smaller base, and it has tremendous growth potential. As in Asia, banks still fund over three-quarters of credit compared to, say, the US, where it's more like under 20%. So we've got a lot of room to go to catch up to the US. Um, and in terms of uh, I guess structuring, you tend to find that in Asia there's more room to customize the deal structures. In the US and Europe, deal structures tend to be quite fixed, and they follow certain fixed templates and have generally evolved into more covenant-like structures in recent years. Whereas in Asia, it's still a lot more possible to customize the type of terms that you like.
Okay, I think the next question is for Wiyap. Um, what, how have the private credit markets been affected by COVID-19? And how do you see the outlook going forward for private credit as an asset class?
Thanks for the questions, Oi. So I think during the COVID-19, a lot of the businesses has been impacted by the COVID. And I think you can sense that in general, the business confidence level has not really come back to pre-COVID time. Some country far more advanced. Some countries are still pretty much under a bit of stress situations. So what it means is that if you look at pre-COVID and kind of COVID situations, the type of deal is slightly different. Pre-COVID, there's a lot of deal type which will classify as a growth-oriented kind of opportunities. Companies try to raise money to expand their capacities, to support their working capital, basically to enlarge the businesses. So that type of deal is much lesser in current environment. But in current, what we're seeing is that there is a lot of refinancing opportunities, even for company that used to be able to tap the bank's market, but because of COVID situations, their cash flow is currently impacted. They have no choice but to tap other form of debt provider, right? Basically to tide over the current situation. So what we find is that interestingly during COVID, there are certain negative aspects, but there's certain positive aspect that the better quality company have no choice but to reach out to the alternative lenders currently. So that's one. Now, in terms of going forward, how do we look at private credit as an asset class? I think that, given that the current market situations is that no one can really predict whether there will be subsequent wave of COVID, whether there will be much more adverse type of variants of COVID that may impact everyone, right? So what I think it would be make sense is that it's basically for an investor to basically try to allocate part of the capital into a less volatile asset class. And I think private credit fund basically has certain characteristic that lends quite well to this particular, to basically to dampen that volatility in the portfolio of investor. There are a few things that that basically helps to achieve this purpose. One is that as compared to say a private equity fund, right? Investment in private credit fund basically tend to rank ahead in terms of seniority, in terms of capital structure, right? That's one. Two, if you invest in a private credit fund in Asia, I think it's what my colleagues have spoken to earlier, is that in Asia, you tend to find that the deal are actually much better structured, right? And you can get better deal terms, right? As compared to, say, the bond. The bond tend to be incurring-based covenant, whereas the private deal, we tend to be able to negotiate for maintenance covenant, better control, more cash control mechanism, even something you can negotiate for a board seat. The third things that lends well to this is that deals in Asia in general has much shorter durations compared to say deals in US and Europe. In US and Europe, what you see is that typically a lot of the deal is actually financial sponsor backed deal, right? So the bank would typically lend, say, 6 to 7 years of loan tenure. So for that second lien, tend to be 1 year, 6 months to 1 year longer. So the tenure is actually much longer. But in Asia, you see that context that the bulk of the opportunity is still resides lending straight to a corporate borrower rather than backing a financial sponsor, right? And those deals generally have a much shorter tenure of about, in our experience, about 2 to 3 years to an exit kind of time frames. So that combination, that characteristics, I think lends quite well in current times, basically to dampen down the volatilities.
Thank you. I wanted to touch a little bit on, we've been talking about how positive and how great it is. What do you think are some of the risks of investing in private credit that investors should be aware of?
Sure. I think for today's purposes, I will basically mention three key elements that an investor should consider. One is the credit risk that the fund is assuming. That pretty much depends on the strategy that particular fund is adopting, right? How far is it willing to go within that credit risk spectrum to get the return? That's one. Two is in terms of the downside protections that the fund can negotiate and achieve to basically to protect that principal. So I think it's quite important for an investor in any private credit fund to basically have a very thorough understanding with the fund manager to understand like what kind of strategies are you adopting? Because in Asia, what you find is that because a lot of deals can be customized, it's quite hard to pigeonhole a strategy just by simple fact. Is it a senior? Is it second lien? Or is it special seed or distress? In Asia, the lines are quite blurred. It tends to be much more important to be able to understand, for each deal, how a fund manager goes about trying to optimize the risk return and downside protection trade-off. So that's one. The second key risk I would mention for everyone is that this is a closed-end fund, like a private equity fund. So generally, it carries an illiquidity risk, right? So investor that invest basically need to be aware of the time commitment period that he's committed to. So basically for fund purposes, it's very similar to private equity fund. There will be investment period, after which no investment will be made, then there will be a holding period. So investors need to take that into considerations. One point to note is that in Asia, generally speaking, the private credit fund, the tenure of the fund typically much shorter compared to a private equity fund in general. So that illiquidity risk is somewhat mitigated by that shorter life spans. Now, the third key thing I think investors should consider is the currency risk, right? There are two dimensions I'll mention. One is that, if the fund is denominated, say in US dollar or in euro, so the investor basically need to consider the impact of the currency, the denomination of the fund vis-a-vis his own personal investment or portfolio. The second dimension of the currency risk is that, is in terms of the loans, the underlying loan made by investment manager, is it always in that fund currency denominations, or it may be in other local currency, right? And whether the manager choose to hedge that risk, right? For example, investment manager may make a loan to an Indian company in local currency rupee, right? So some fund manager may decide to hedge it back to US dollar, right? So the return is actually much more stable than. Some investment manager may decide not to hedge to get the extra return, but the fund basically was subject to the FX currency volatility. So I think that's one key elements to consider. So for today, I think for today's purpose, I think these are probably the three key risks that I think investors should consider.
All right. Let's come back to SeaTown. What do you think are some of the, what are your key competitive advantages as a private credit investor?
Cool. All right. So I think for SeaTown, for this business, I think if we look at our competitive advantage, I'll break it down into two broad components. One is deal originations, and one is the deal executions. Now, in terms of deal originations, what you see is that over the 10 odd years, SeaTown actually built extensive network of contacts. And that contact has able to provide us with a constant deal flow over the years. The second thing is that we are able to tap on our parents' broader relationship because through its own investment activities, through our parent investment in other private equity fund, they will generate private credit opportunity for us. So this type of flows tend to be much more proprietary. They're only known to SeaTown. So in a way, that's provide an icing on the cake for us and expands our deal flow channel very effectively. The third is the branding effect, I would say, that SeaTowns carry. If you look across companies in Asia, the smaller and the mid-sized companies, a lot of these companies, besides the dollar that they are seeking to raise, they also value the advice and the branding that can carry together with the money, right? So for us, before we make an investment into any particular company, we carry extremely thorough due diligence and background checks on the companies to ensure that it passes our investment thesis and our hurdle, right? So an investment by SeaTown fund will basically indicates that the companies basically have passed through our processes, right? And that actually represent a very strong market signal to its customers, to its supplier, to its banker, and to its wider communities at large. So we believe that the branding is a source of alpha for us. There's a couple of transactions that we've done. We are able to achieve a very much higher return compared to other offer the company have on hand. So that's on the deal origination fund. Now on the deal execution side, so beside the due diligence work that were performed by the team member, we've been able to leverage on our parents' wider groups of companies. We're able to tap insights, provided by someone who is on the ground in the different countries, in the same industry, and we're able to tap that insight on a very timely basis. So basically, that helps us to basically address a few things. One is that quickly pinpoint whether should we be dealing with this counterparty, right? They can avoid a lot of heartache down the road. Second, it helps to pinpoint the key issues that we need to consider if we want to proceed with the transactions. And third is actually provided help and assistance along the way as when we need guidances to deal with some local issues, right? The next point I would say is that if you look at SeaTown as compared to other global fund, right? Our IC and our team members are generally local, right? Based in Asia, we grew up here. We can understand the context of operating in different countries in Asia, right? Asia, it's an extremely fragmented market. You come to think about it, right? Every country has its own language, law and regulation, its own business community, and there are cultural norms, right? Which can be quite complex. So when we approach deal, we tend to take a much more nuanced and much more granular approach, to factor in all of our understanding about the borrower, its operating environment, and how we should be tackling those issues in the most effective manner. So I think these are the two key core advantages of SeaTown as a private credit investors in Asia.
Great. Thank you so much for that. We have a number of questions from our participants here, but before I start there, actually, maybe this is a question for Eddie. And I think obviously the private credit space, I mean, you would have seen in your past experiences some level of default or some hairy situations, right? What are some of the key lessons coming out of those?
Well, I mean, to be honest, for us, we don't, touch wood too, we don't see too many of those. And I think, in fact, we see very, very little of that in our entire investment history since 2012 till now. And one of the key, I think, reasons for that is because when we structure a deal, right, we are very conscious and religious about protecting our downside. That's one. And that definitely helps. The philosophy of the private credit fund or private credit investments that we have made over the years, first of all, we look at performing credits. We don't really look at, I would say, the distress space. So that helps on that. We think that management time is better spent on performing credits. Over the years, over the last decade, I would say, we have encountered some pretty high profile corporate defaults. It has gone through a stage of restructuring with the courts. We were involved in, for example, some shipping company loans, etc. And because of the nature of that industries, it has its fair share of volatility and its fair share of challenges in terms of credits. But we came out quite unscathed at the end of the day, simply because our position was quite well collateralized. So the way we look at credit is pretty much not so much of putting on an equity lens. The equity lens is important for us to really understand credits. I think all of us, the benefit of the SeaTown team here is that most of us at one point or another, been pretty exposed to equity investments. Because of our background, we started off pretty much as a multi-asset shop back in 2009. So we had the benefit of understanding equities before moving into credits. And the understanding of how different instrument plays its part in the entire capital structure stack is important. As a credit investor, one should really understand the potential of the equity of a company, when they invest in the credit, not just the credit per se. That's important. And so because of that, the way we structure our sort of private credit investment has more often than not take into account on market volatility of the borrower's equity as well. And that's important to when we arrive at a credit structure to sort of minimize the downside risk for ourselves.
Great, thanks, Eddie. Let me see. Okay, there's a question here that's quite interesting, and I thought we should address that, right? I mean, we always assume that actually Asia is relatively well banked. Why would your corporates choose private credit lenders, such as SeaTown, versus a traditional bank? Where's the shift in that?
Well, I mean, if you look at history, right? I think for some of us who are a little bit longer in the industry with institutional memory, we can relate to, let's say, back in 1997, there's an Asian financial crisis, and also back in 2008, where we've gone through the GFC. I think in the days of 2007 and 2008, to be very honest, a lot of banks were actually in the private credit business, pretty much originating out of their prop desks, and they were pretty active investors in those days. But since then, because of the GFC, I think a lot of the traditional banks that you see have pulled back from the market, and that throws up a lot of scope for players in the private credit space to actually fill that void. That's mainly the Asian market. And also, what's interesting is that you have in front the slides showing the different type of composition of bank lending in different markets, in the US, in Europe, and in Asia. What I can say here is that the region that has the greatest amount of disintermediation in terms of lending is probably in the US, where most corporate has gone directly into the market to borrow and very little reliant on the traditional financial institution like a bank. But in Europe, you tend to see a little bit more, all right, 50% of that. And in Asia, you still see the highest amount of bank lending, which means to say that the Asia market actually has the greatest amount of potential when you talk about corporates over time moving into direct borrowing relationship with private credit lenders. One of the things I think the banks today, traditional banks, find it challenging to really step up maybe in the private lending spaces because of the capital charge that they have to really set aside, right? It doesn't make good commercial sense for them to be focused in that area. Level 3 asset, as you have seen over the GFC, has been something that people like, traditional banks like to stay away from. But for us, I think, who are in the business of private credit for a long time, as what Wee-Yup has alluded to earlier, there's a lot of nuances, especially in the Asia private debt market, where you really need to understand in each jurisdiction where some of the key risks lies, what are some of the business practices, and the reputation of the borrower. I think that's very important to us. And that's, I think, the key elements, the key characteristic of the Asia private debt market. And therefore, we see that there is a lot of scope for why some of the Asian corporates, not just your major listed names that are, I mean, the traditional listed large companies, but also the so-called SMEs in Asia, that their needs when it comes to private borrowings needs to be far more customized than what a traditional bank is probably able or willing to handle.
Just add to Eddie's comments. If you take a look at a typical Asian, say, mid-sized company, right? And typically, once that company need to raise money, it tends to goes to the bank. Their relationship banks to tap up to borrow. The moments that the mid-sized company fully tap out on the bank's borrowings, right? Typically, the options that it has tend to be very much more limited, right? If the company is large enough to issue bond, it can tap the bond, also depend on the bond market situations, right? If not, if this is a private company, then its options are quite limited. It can tap on the private equity money to fund the growth, but as we know, private equity capital is quite expensive in terms of the MOIC requirement, in terms of the net IRR per deal requirement. So there's some space, especially in Asia. Generally these are bank-dominated market so far. So the moment the bank say no, most of these companies actually have very little or very limited option. So the market in Asia, if you look at it, is very different from the US and Europe, and that is where you see that in Asia there is actually less competitions among the funds, because the market is still pretty much largely untapped.
Actually, while we're on that topic, I mean, within the emerging markets, what do you think of the opportunities in Latin America, for example? And would it be a place that SeaTown would be looking at for investment ideas?
I would think in general, no, simply because we are based out of Singapore, right? If we look at a Latin American deal, it will likely be through our own proprietary network with Temasek, because as you know, Temasek has local offices in Latin America, both in Brazil and in Mexico. And we know we are pretty plugged into the guys on the ground there. Now, if a proprietary deals come through us, through our greater Temasek network, or through sometimes it could be through a private equity fund that both SeaTown and Temasek has a very strong relationship, we would look at that company simply because we know that we are partnering with a very strong equity sponsors. We are also able to monitor the company very closely because of our on-the-ground officers. And also the strong relationship with the equity sponsor helps in us getting timely information on the developments of the company. That's the only time that we probably look at, let's say, a deal that is really outside of Asia.
But do you have a target, does SeaTown have a target sort of allocation across geographies or sectors, or anything you're avoiding at the moment?
For us, when SeaTown looks at private credit, we are pretty much Asia-centric. We are, cognizant of the challenges in looking at markets that are perhaps harder for us to monitor and perhaps we don't understand as well. So we would like to stick to our areas of strength. When we say we look at stuff that we really know.
There is a question around spreads in public credit markets are historical low, or it's now very tight. Are you seeing the same dynamics in private credit with returns compressing?
Yes, we are seeing that in certain industries. But the nice thing about private credit is that there are opportunities for us to actually make a decision to say, in those sectors that we see the spreads are trading very tight and we think that credits are trading expensive, right? We will then move into other sectors, obviously, that we think still offers compelling spread between the public and the private. And we can also augment our credit return sometimes through building in some equity kicker in our credit structures. Quite unlike the public credit markets, where if you are invested into a typical high yield or investment grade bonds, they are generally unsecured. The format which you invest in is pretty standard. It doesn't come with any additional bells and whistles for you. There will also be no scope for you to customize your credit, your return structure. So I think for us, we have that benefit and we continue to capitalize on that. Even during this, what you call it, low rate, compressed spread environment, we continue to be able to see opportunities get from a private credit standpoint, from what we are doing in our strategy. It's still pretty attractive.
I mean, we talked a bit about the structuring and the collateral, and I know obviously and the equity kickers. How do you then mark to market this, or how do you, what does the NAV look like? How would you explain that to investors?
For us, we are pretty transparent on that. We utilize a independent third-party valuer to value our portfolio on a quarterly basis. So that's absolutely transparent to all our investors, how the positions are marked. I think these valuers, they have been in the business for a long time. They are very well-known names, and they have done this with many other illiquid assets. So they approach it from a variety of valuation methodology. Probably won't go into them, but I think safe to say that it's pretty market-based. They, of course, don't look at comms, and they look at the actual structure of the credits and the cash flows of the instrument.
Good. Sounds like there's a lot of backup going on there. This one is a very interesting question, and I'd love to hear your views. How are you all viewing the Chinese credit situation with big names like Evergrande and Huarong? And would SeaTown consider such credit profiles?
I think on that, we have to be selective, to be very honest. We don't necessarily see the China situation as entirely negative. It might appear quite negative for, I would say, maybe an equity instrument. But for credit, I think we continue to believe, one, that while deleveraging is going on, we think that the deleveraging in China is a healthy one. And in certain cycle or pockets of the deleveraging, there is a space for private credit. We would like to think that as some of these companies delever, in China, they eventually end up being a stronger company in terms of their credit metrics. And we like to pretty much play the role to actually help some of these companies to assist in the deleveraging efforts, so to speak, by providing them some form of a private credit solution.
And just to add on to Eddie's comment, I think for the Chinese real estate so far, I think what the deal that we are interested in, it tend to be a private structure around and ring fence again a certain part of asset, and that loan typically will rank way ahead of the rest of the public bond. That's how we like to play in that space.
Good. Well, I mean, as you're, I mean, obviously China is very topical at the moment, right?
Sure.
That's right.
And let's talk a little bit about, well, since this was asked, your relationship with Temasek. I think this is a very, very rare peak. I mean, just a reminder to our viewers and our participants, this is a rare peak into SeaTown, right? Because I don't think SeaTown has any sort of non-Temasek investor. Do you think that there's a bit of is there a risk of over-reliance on Temasek? How is your team, developed, and sort of, are they standalone? Do you rely on them a lot? What's the dynamic there with Temasek?
I think, first of all, we are very independent from Temasek, to be very honest, the way that we operate. We have an independent board that does not have any Temasek employee. We have an investment committee that comprises majority of the folks here in the investment team. None of us here are from Temasek, at least not right now. And then there are other folks that is not on our IC. They are also not from Temasek. The folks here that you see, we are all pretty much aligned in the sense that we are all invested in the fund. We have our own interest in seeing that the fund does well. So to that extent, do we really rely on them on decision making and the key operation matters of the fund? Probably not, to be honest. Do we work together on potential opportunities? Yes, that might come from time to time, right? I think that's if they have a proprietary deal and for some reason that they may not be able to participate either because the size is too small, or concentration could be too high. I mean, that's where I think we can actually have the opportunity to look at some of these. But more importantly, I think what we are seeing here is that, and how the external investors, in terms of when we invest in a transaction, how a borrower view us is that they pretty much like to work with someone with a strong hand. They like the fact that we are able to lead transactions and to garner support for their transaction with other investors. And so that's important to them.
Maybe to add on to Eddie's comments, while the Temasek connection does give us an edge, it is not we're not 100% reliant on it. I mean, we do get a lot of deals from various a lot of the other sources like investment banks, deal brokers, and other sort of proprietary networks that we have built up over the years. Other PE funds that we have invested, we have supported and invested with over the years, and also in terms of being able, our name is fairly well known in the capital markets. It's not just don't only get deals from Temasek.
So in summary, you think about it, right? The way that we run our business is pretty much is independent, right? But when we can leverage resources from Temasek to help us to do our job better, we, why not, right? Right. And you look at Temasek, I think the key question is there conflict? I think that's probably a more critical question. so far there's been very minimal conflict because you look at Temasek as a firm, it is a largely an equity firm, right? The bulk of investment are all in private equity, in equity investment. So Temasek is not really interested in the debt side of the business. So for us, it works very well because there's a lot of synergistic, relationship that we had for this particular business.
Thank you. There is a very interesting question here about ESG. What is SeaTown's? Do you have a ESG lens? How do you think about ESG when you're putting your fund to work?
I think yes, we are definitely very focused on that. We for every single investment that we make on, we obviously want to make sure one, the industry that we lend to are not ESG unfriendly. So we tend to stay away from, businesses like coal mines, businesses that are like in gambling. We are not involved. I think these are some of the basics that we stay away from it. We stay away from them. And quite apart from that, every single investment or credit investments that we make, we want to make sure that a basic ESG framework is being covered in our investments. So that, at the point of investment and also in continuing that investment during our investment horizon, we want to make sure that if there are areas where the company needs to get up to speed or be up to scratch in terms of their ESG standards, we will communicate that and to have it in a way part of the the lending agreement.
All right, I think we have time for one last question, and I'll leave it to you, Eddie, how you want to answer this. There's a question from a participant around SeaTown's performance track record. I suppose you can keep it as high level. Okay, take more detailed questions after this.
Okay, I'm not sure how much I can actually say about the exact track record, but I mean, we have been, I think, the fact that if you look at the history of SeaTown, we started off in 2009, pretty much doing a variety of investment strategies, right? From public equities to public credits to private equity and private credits. And over the years, the fact that we are bringing out specifically, we have sort of set up a private credit team, a dedicated team, and running a private credit fund as a business. It's sort of a testimony of our belief that as a product, we have done well. I mean, I think it's a very respectable set of numbers over the last decade. And because of that, it warrants the firm putting dedicated resource in growing this part of the business.
All right. Thank you for that. Saying as much as you can.
Yeah.
I think Alex has got a final slide here to complete this. I actually wanted to make a few closing observations from this discussion. I think it's been, what's quite clear to me is clearly private credit, first of all, is a much more attractive asset class. I mean, especially in current times. And clearly there's a space where private credit funds are stepping in where the banks cannot, right? But in order to do that, actually, as I say to people, please don't try this at home, right? It's the kind of asset class you can't just like punt on a REIT or punt on a bond, I think there's clearly a lot of work that the fund manager needs to do to ensure that the structure is right. If there's any problems, if there's, you need to think about the follow-on effects of that and the enforcement and all of that. So we sort of lightly touch upon that. And also it's more the origination, right? It's not like, the first deal that comes into anybody's door is the right deal to do. And clearly, I think the SeaTown has had a lot of experience, a very, very strong network to continue that deal flow that makes the fund successful. And so I think, there are many sort of takeaways from this discussion, but I would like to say that, I think the final conclusions here are, if any investor wants to look at private credit, is really to think about investing via a strong fund manager like yourself, right?
Well, I mean, I think I definitely agree with you on the point that in private credit as a product has typically much higher barriers to entry, so to speak. For one of a better example, I would say, like, as an individual, if I want to buy, let's say, a public listed equity, it's probably quite simple to just go online, open an account, and go online, do a few clicks, you buy the stock, right? Almost in an instant. But I think for something like even for public credit, for that matter, you could easily buy some public listed bonds. But for private credit, yes, you are definitely right on the fact that it's not easy to access those opportunities. It is also not easy to be able to do the analysis that is needed because of the complexity of the structures and because of all these barriers to entry. To be honest, returns in that space has continued to be attractive. It is not something where it's accessible to everybody, and therefore you sort of open the floodgates of capital coming into this space. Yeah. So from that analogy, yeah, it is something. That's why earlier when you asked the question about compressed yields and all that, do we see it really affecting our private credit space? The honest answer is probably not a whole lot.
Great, fantastic. Anybody has any questions, please send them on to Alexander Lee at ADDX.co, and we can forward them to the team here at SeaTown. But everyone, thank you so much for joining us. I want to thank the three gentlemen here, Eddie, Wee Yap, and Wei Xian, for joining us. Thank you for spending the time with us. I hope everybody had a great session, and see you very soon next time.